And that's really a question for Chris.
Yes. We are at pretty close to 13% right now in private equity. Inflation sensitive and absolute return will be a bit more difficult. Both right now are innovation portfolios. We do things in small laboratory size, but we built the platform for absolute return so that it could hold a lot of assets, so we could increase that over time. It both will come at higher cost. Investing in both of those areas are more expensive, and we've known that. And that's factored into the model. These are net returns.
All right, Rich.
So I actually found this little piece helpful to me. I would probably be vaguely on the other side of the triangle, right, along the efficient frontier. I'm using this model as a location, but I think this makes sense. Doesn't bother me. This kind of outcome doesn't make sense. I think we ought to have some conversation about how we really want to allocate among the classes to keep it in that general area, as opposed to spending our time worrying about since I don't know what's underneath the boxes, right? I think we ought to spend some time fiddling with the actual allocations to get there. But we're pretty close to in the ballpark here. You can argue, I would argue that the things are going to be a little better in the future than they've been in the last few years. And so I'm willing to be a little more aggressive. Some people are more worried about that, and I can understand that. But that's a guess, right? I mean, that's just a sort of a guess about our tolerance and how well we can prognosticate the future, which I will admit I'm just as bad at as anybody else. So we're right around where we want to be, which is a nice sign.
I would, you'd looked at two allocations here. The key difference was the allocation to absolute return, which was 6 before, and public equity was 46 before. So this one, in a sense, this allocation that you're looking at now is on its way to the other one. So, if we went through this exercise 3 years, you do have a 0% allocation to absolute return right now, and Chris can correct me if I'm wrong, but it may be a challenge to get to the 2% rather than the 6%. So why not maybe go with if this is where you want to go, this is a good starting point, and we can review it in 2 or 3 years and see if you want to progress further.
And with your permission, what I would just urge you to focus on is just the two columns where it's the best and the current, and where the difference really is. And if you think about it, it's really pretty intuitive. It's taking money away from fixed income, which most people consider to have the probability of a very low rate of return for the next decade, using the yield to maturity that's available in the bond market today, and moving those to assets which are less correlated to equities but have slightly higher rates of return. And that's what the model's telling you, which is very intuitive. And this would be not a huge move, but it would be a significant move. And you can revisit it at any time. That's at your prerogative, but you are going to revisit it as a matter of course in 3 or 4 years when you do this all over again. And hopefully we'll use new factors that everyone agrees to.
And one other comment on the risk tolerance weighting between 1 and 4 is under the prior scheme of 3 and 4, that was in an asset-only construct, one maximizing, finding geometric return, and then reducing, protecting the downside of return. With 1, you're bringing into your risk tolerance a notion of the financial condition of the system, because it's talking about funded progress. So you have a balance between the returns of the portfolio and between the funded nature of the system in terms of expressing a risk tolerance. That's a nice balance.
Paul?
So
I think.
Oh, Paul. Paul's first.
I think the issue of implementation is a really important one, and whichever one makes the most sense to get to roughly the same places is I'm kind of indifferent to. I did want to, though, make it clear why I am, because we're talking about philosophy here, I think, and it's not just risk tolerance or my outlook on where the market is going to go. I think as I've said a couple of times before, I have a very different approach to the risk that the system should take when we're in a very, when we're in a situation where the funded status is declining and will decline unless we address the funding problem, or the legislature addresses the funding problem. I would have a much more aggressive approach if we had the funding problem addressed. But my concern right now is until the funding problem is addressed, a significant loss in this system would be a real difficult problem to dig myself out of. I might be much more where Tom was if, you know, if we had the SCR 105 option 1 approved and we were contributing, we got $4.5 billion of additional contributions to the system, but we're not there yet. And so until we get there, I'm pretty conservative, and that's why I'm at 65 for number 4 and 35 for number 3.
Hopefully in 3 years, we'll have a different conversation, but. Tom?
Two things. One, I think probably we've hit a good sense of risk tolerance here as I read the numbers in our process. My guess is that there's quite an array of portfolios that Chris could create to hit that risk tolerance. And it strikes me as counterintuitive in the current environment to making a large commitment to inflation-sensitive assets at this point. So I'd say if we say we've settled on risk tolerance and we know where we want to sit in the efficient frontier band, we should ask for some guidance from both our consultants and the staff as to what asset allocation would look like in that environment, so that we're not the model. We're not a captive of the model in terms of where we're actually putting the money.
Tom, can I just ask you a question and then, so are you saying that you think that, can you remind me what you're saying about inflation sensitive, that you feel like that's not a place where we want to move?
It's not a place where people are moving aggressively now because we're in a pretty low inflation environment. We're at risk of having a lot of dead money for some period of time or low return. But the fact is the model produced this with a set of constraints, and it gave us a point of reference on the risk return horizon. I think our investment professionals and team should tell us what's an optimum portfolio look like and asset allocation against that risk return, because they are really different things in my mind.
That's helpful.
Sharon,
Yeah.
I'm sorry, Tom, are you done?
Well, I was going to say, I was going to ask for Chris to talk about it.
So I'll go first, and Alan will jump in. You know I love analogies. What Tom's talking about is the next step we would come back to. Literally, we would be moving from, I think it's a triangle to the square. Even though those are very close in the chart, we're talking about a couple of billion, several $billion, almost $10 billion of movement. We would literally, in my analogy, we'd chart a course sailing-wise from here to there. That would be our general guideline, but then we'll make those asset allocation shifts depending on the market environment. And if the opportunities present themselves, we will move more quickly, otherwise more slowly. And what it means for you is every year you would adopt a new policy asset allocation that you would use to measure our performance and you'd use to measure in the incentive program. But they would all be stops, milestones along the way as we move out that curve.
Okay. Thanks, Chris. Michael?
I just want to bring us to introduce or reintroduce the charge that this board has under the statute, which I've always kind of struggled with, because if I recall correctly, and I defer to Ian on this, that we have a duty to minimize losses and maximize gain, which the two can't exist in the same universe at the same level. And what I do in order to reconcile those two is to go back to the statute that is the basis upon which the California statute was written the fiduciary responsibility provisions of ERISA, which in the statute has a focus on minimizing losses. And so I come from that perspective, that as a fiduciary, our job is to preserve the capital that we've been given, so that it is there for providing the benefits. We cannot earn our way out of this hole. So, as Paul has repeatedly said, this works only if we get the requisite contributions. But we shouldn't make it more difficult for the contributions to do their job by losing any more money. So that's why I put a higher emphasis on the risk tolerance issue rather than the return. Because I think from a statutory and regulatory standpoint, our primary function is the preservation of the assets with which we have been entrusted. Certainly, to earn as much as we can with respect to them. But in the conflict between maximizing return and minimizing losses, I believe that our charge is first and foremost to minimize losses. And second, to earn as much gain as we can in that context.
No one else is in line, so I'm going to encourage us to try and wrap things up. So where do we go from here? We have kind of our, from what I see, 53% on the kind of return side and 47 on the.
Sharon, from our perspective, we're good to go unless you want to vote one last time. But if the board is comfortable, you would move adoption of that asset allocation and those policy targets.
I want to see how persuasive my speech was.
You would re-vote again.
Come on now. Okay, that sounds great. Rich?
Well, one piece of your comments, are we accepting this asset allocation? Because I'd like to, for example, along with Tom, I'm concerned about the inflation sensitive, which is almost all hedge funds. And I think that, well, at least from the description that was in our appendix, it's almost all hedge funds.
Absolute return.
That's absolute return.
Sorry, absolute returns.
Inflation sensitive
Excuse me.
infrastructure tips.
Yes, excuse me,
Commodity.
absolute returns. And I'm okay. I'm concerned about that, I guess, a little bit. I would lower, I find those very difficult. I don't know how you find them. I suspect they're very difficult to manage. And I'm not sure of that they're, maybe 2% are okay.
Alan, do you
I
want
don't
to
know.
chime in, Alan?
Never mind.
Could I,
Let me get Alan and then I can grab you, Tom. Oh, okay. Go ahead, Tom.
so could you, I don't know if your model allows us to tweak the asset allocation here?
No, it does not.
Darn. That's what I was doing.
Yeah,
That's the problem.
but
But we can talk about it.
yeah, so I would
Doesn't INV
suggest
101?
that as we said minimums and maximums in this, that the
Yeah.
swing factor be allocation from equity to inflation sensitive or absolute return more than, we've got 7 points floating around here. And if you want to do 2 or 3,
The second-
2/3 from equity and 1/3 from fixed income, I'm not sure. But the idea being it's going to take some time to move that much money in that direction, and where's it going to come from and how fast?
Alan?
I think for that one, I have a good answer, and that is, for each one of these, we would come back with an implementation plan, and they would be market-driven, and in the event there really weren't opportunities or the board was not comfortable with the implementation, then the assets would stay in the traditional asset classes. They wouldn't move to those other asset classes, and you'd get to approve that implementation plan. So, for example, using the hedge funds as the example, Mr. Zeiger, we'd come back. If you said, we're not comfortable, that money was coming out of public equity, it would stay in public equity if you weren't comfortable with implementation. Does that address? And that would be true.
It does, as long as it doesn't override the biggest move in this allocation right now, which I think we all agree on, which is diminishing fixed income.
No, it would not.
Yeah.
And there would be rebalancing or management ranges around each of these targets as well.
So it's an action item, and how do I frame?
What I would do,
Can-
with your permission, I
Yeah.
would just basically have a motion that gives those weights and say those are the new targets, and the staff and the consultant have to come back with an implementation plan for your approval.
And I would add, as reflected by the risk tolerances expressed as as the collective group's weighting on 1 and 4.
Is a lawyer writing all this down for me? Dana?
Before we go there, Alan and Neil, will you guys weigh in more on the inflation sensitive?
So,
Leaving it out at
six targets
7?
in the box.
Yeah, on INV 118 is the structure that was used to model that class for simulation purposes in the model. It is largely TIPS, publicly traded TIPS, but there is about 30% in other segments, including infrastructure, commodities, timber, and agriculture. And those, going to your point, those are particularly timber and agriculture and infrastructure, where STRS has, been looking at pretty seriously for about the last 5 years. It is hard to ramp up those. It would be a challenge to ramp up those segments. But to build an implementation plan, and there is, from a modeling perspective, it's hard to, there is uncertainty more so than on the other classes when you're trying to build these segments and put them together. So there is plenty of flexibility around the allocation. If you're concerned about what TIPS are going to do, you might put a range around TIPS, for example, of within the inflation sensitive class of maybe 50 to 75% or something like that, and give yourself some flexibility to utilize those other segments.
So then, do you think 7% is too aggressive? To
Well,
try and
again,
get there?
there would be an implementation plan. You're at 2 now.
I understand.
And if you're gonna move to this new allocation target of 7 over a 3 to 5 year time frame, that's probably reasonable. I wouldn't say
The
that
important
would
thing
be
that,
aggressive.
what it does, it reflects that this board has a concern about inflation, and that you want a portfolio design that addresses that risk, which is not addressed explicitly and directly in other parts of the portfolio. Practically speaking, TIPS, which are the easiest way to get an inflation-sensitive and least expensive way investment vehicle, aren't priced very attractively right now, although they're a lot more attractive today than they were 6 weeks ago.
Yeah.
6 weeks ago, you
Yeah.
had a negative real rate of
They're
return.
producing a real return for
And
you.
now you have a real rate of return in
Right.
TIPS. They've become a lot more attractive. So we need to reflect that. And that's because the markets are so dynamic. The implementation is as important as the direction.
Right.
So if I can add, as we keep saying, we're at 2% now. The board's current long-term target for inflation sensitive is 5.
Okay.
And that has been true since 2009. We ramped
Makes
up
me
pretty
feel better.
quickly and then took it back down, as Tom said, due to the movements of the markets.
Right.
Again, we don't chase targets, we're investors. So, and as they said, we could easily move a very large portfolio. We got over almost to $2 billion in TIPS. We could move very quickly. Infrastructure is about to hit $1 billion. And as Neil said, we have been studying timber and mostly agriculture. That would take time, but we have ideas.
I've got 3 folks in the queue, and I'm going to just try and keep it moving. And so, Rich,
So I have this incredible desire to reverse engineer. So let's just say I wanted to move 3% out of inflation sensitive and 1% out of absolute return and move them over in equity. What would that do? So that equity went up by 4% to 54%.
Well, qualitatively, without knowing the number exactly, you're going to marginally increase the expected return on the portfolio and increase its volatility across all the horizons. So, I mean, it will sort of defeat the purpose. It's probably equivalent to going to 30% on number 4. Right? You're taking away those two classes offer up downside protection, and you're taking those away. So it's like you're changing the risk tolerance to push more towards 1 instead of 4. And maybe you get 20 basis points of excess return out of it. Maybe.
Tom?
Well, again, I come back to having sort of defined a risk tolerance. I'm not sure I'm not sure I was voting on asset allocation at the same time with my heart, and I'm particularly concerned about inflation-sensitive assets there, but which I don't think we really expressed a concern about. Our concern was about really volatility. So I would I'd be inclined to somehow structure the vote so we've agreed on a risk tolerance.
I agree with you.
And ask the staff and the consultants to come back to us about asset allocation that mirrors or approximates this risk tolerance, which obviously there are ways of doing.
I'd like to make a motion, actually.
Okay, well, can I just get a response before Paul? Is that, so the suggestion was voting on the risk tolerance and waiting on asset allocation?
I think just to follow up on your comment, I think one of the trades also going on here is, you have this it's the trade between inflation-sensitive types of assets and fixed income.
Right.
And, what's the prognosis for fixed income going forward? It's maybe worse than for inflation-sensitive type assets. So that's what the intuition and the assumptions, that's what's being built in there, is that fixed income, it's going to give you principal protection, but you're probably going to get better results on inflation-sensitive type assets over the intermediate to longer term.
Okay, so I have a concern about just implementation. If we're looking at a 3-year window to implementation, that I'm not sure would be a really smart set of steps to be taking over that horizon. I mean, I just invite some further thought about it. Maybe it's a point or two move to real estate. Maybe it's a point back to fixed income and a point to real estate. You guys have the model to work with, but I somehow just think we're using blunt instruments here.
Well, just to comment on the real estate, and the staff can correct me if I'm way off base, but your real estate class is more of a total return type class than it is geared strictly towards inflation protection. So you're not getting perfect inflation protection out of real estate.
No, I wasn't particularly. All right, I think my point was we didn't vote about inflation protection here. We voted about volatility and portfolio volatility more than anything else. And I think given everybody's concern about default, which I share, or drawdown, which I share, I understand that. But to have the net big swing, inflation sensitive assets, an asset class we've just pulled back from, everything you read is it's a fairly low inflation environment for a long period of time. I think it needs a little more thought.
Let me just reiterate what I think I hear Tom saying as a good professor, gotta rehash, but basically it sounds like you're saying, let's vote on the risk tolerance that we this process that we just went through. And then when we look at kind of the implications of that for asset allocation, that staff and PCA help us guide a conversation perhaps in our September meeting? Is that?
Yeah.
I mean, yeah, the question is, there may be some other allocation ideas reflecting the response.
But could we talk about that, I guess, is what I'm hearing the member bring up.
I think what we're talking about is subtlety, and I think that this is not subtle, and there's no problem. Once you give us the direction, and we can truly do that either in the frame of addressing the targets, or in fact deal with it through implementation and give you choices on that.
So the direction you need is our risk tolerance though, correct? Right. Okay. And we've
And I think
gone through that process, so
if you as a consensus say that's the general direction you want to go, we'll come back and fine tune it.
so, Mr. Rosensteel?
Yeah, and that's precisely the motion I'd like to make, which is that we've pretty much come to a risk tolerance, whether it's 53-47 between 3 and 4, or 53-47 between 1 and 4. We're coming out to pretty much the same outcome by the standards we're looking at, which are standard deviation and return. And I think we've got some consensus that that's a pretty good place to start. The implementation is a separate question, and it does have implications for what the portfolio it has in it, the asset allocation. But I would suggest that we approve that and ask the staff to come back with a specific asset allocation that gets us to that risk-return outcome, that thinks about the efficiency of implementation, and perhaps the diversity of other risks that we might be exposing ourselves to or protecting ourselves against, but constrained within kind of either 1 and 4 or 3 and 4. And that's
Is that
a very
motion?
complicated motion, but that's what I move.
There's a second on the floor. My only comment to that, Paul, and my only concern, or not even concern, but the question I have is just, we've spent, I think this is our 7th meeting on this particular item, and I certainly wouldn't want us to have that continual process. Because we'll basically be ready for the next, asset allocation. So I'm just wondering in terms of timeframes.
There's no conflict between where we were going to come back doing an implementation plan and giving you some implementation options, so I don't think there's any inconsistency.
So we've got a motion on the floor and a second. All those in favor, say aye.
Actually, do you mind?
Whoops, sorry.
It was a great motion. It had lots of stuff in it, but for simplicity,
Lots of stuff in it.
may I parse it out just for the record?
Thanks, Brian.
Go ahead.
I'm sorry.
No, if you can summarize it, great.
So I see it. I separated it into 2 parts. One is
I just want to grab Tom before you do that, so we have clarity.
So I think what Paul is saying, what I'm saying, are pretty much the same thing. We've come to a consensus about portfolios, expected return, volatility or probability of drawdown, and risk associated with that. The concept I'm adding is the likelihood of drawdown. And we've hit characteristics. We'd like then, in talking about asset allocation, some more guidance from both our consultants and the staff in terms of what the target asset allocation would actually look like then, and in their optimum scenario, given those characteristics, and how they would implement it. Is that fair?
That's very
And
well
now
stated.
we'll turn to Brian to
helps
just
Brian,
take
then.
all that
Great.
together and make it concise.
Well, thank you. So I believe that the first motion is to adopt the risk tolerance aggregate weights as voted by the board, and I have, for the purposes of reflecting back to the item, 53.3% to decision factor number 3, 46.7% to decision factor number 4. And that's one part of the motion.
No.
No, okay.
The idea
Here,
was,
Paul,
we haven't,
click in, sorry.
I'm sorry.
Can you-
We haven't,
I think mine's live. Let me.
Oh,
Okay. Oh.
I got Paul.
I'm sorry. That we're pretty in terms of the outcomes, by the way that this model measures them, 47% for number 4, and then 53% for either number 3 or number 1 get us to about the same place. And so the committee is saying we're not choosing 3 over 1 or 1 over 3. We're sort of saying both get us to the same place. So now what we're in, and both by the measures of expected return, volatility, drawdown risk, and all the criteria that have been shown to us, they get us to the same place. So we're saying now that's what we want to get to, but now come back and tell us how we get there in terms of the specific asset allocation and the implementation considerations for getting there.
Can I help him a little bit?
Yeah, if you guys could just make it, even for me as a non-finance person,
so-
break it down to simple terms.
This is a little subtle,
concise.
I think, unfortunately.
Little subtle,
The
I'm just
50
fifth grade.
the 53-47 split is there, and it defines, if you were to, it would define a risk tolerance, a volatility tolerance, and other things. And so that solution set is what we've picked. There are numerous ways to manage the portfolio against that solution set, and that's what we're asking for more guidance and evolution from the staff on. So does that help you in terms of
do we have a
draft?
motion?
So it does. Understanding it and articulating, I'm still working on that.
I think Tom did a great
But
job on that.
I do think that
So I guess what.
adopting
if I could-
the risk tolerance
So maybe-
percentages as agreed upon
Maybe
by the board.
let me suggest that perhaps in terms of a motion that we could say something to the effect that we're putting a weight of 47% on item 4, and that you can use a mix of the elements in item 1 and item 3 to get to a 53% weighting. And that the staff in developing the plan to come back to us can use elements from either of those in order to bring back an asset allocation formula. Would that help? Does that sort of clarify where we are, that we're okay with elements from either 1 and 3? Because there are some differences between the two, and that we're okay with them doing a mix to get that weighting.
Couldn't we just say risk and return too? I mean, isn't that kind of, I mean, in general, the red and the green? I don't know, I'm just trying to.
47% to avoid the 2-year drawdown.
Right.
And then 53% on a mix of the elements of items 1 and 3. And staff to bring back a recommended implementation plan that reflects.
An allocation,
Allocation,
implementation.
yes.
Terry?
I think we're getting
Oh,
close.
I'm sorry, Tom. Let me get Terry and then Tom, you can just take it home for us, okay?
I just want to say, I felt that in many respects, at least in my case, I did not assume that I was doing a final vote when we came up to this point where we are right now, the 53-47. I thought we were still just like in the second round of looking at this.
Okay.
I don't necessarily want to change my vote, but I want to make sure that everyone has an opportunity to have their final vote in
Thanks, Terry.
for this before we act on this motion.
I appreciate that, Terry. Are there any other board members before I go to Tom that feel like they want to change their vote or vote again or? Okay. Thanks for bringing that up. I appreciate that, Terry. Tom?
Okay. Thank you. I think we're still confused because I don't think it's really any more a choice between 1 and 3 is the opposite. I mean, I think what we've done is defined in this process subtly a risk level that's implicit in this outcome. And so if I could amend your motion, Paul, to say, that we've accepted the risk tolerance established by the 53-47% split, and now we are requesting guidance from the staff and from consultants on portfolio construction that matches that risk tolerance.
Do you accept that friendly amendment?
I think we've expressed it many, many different ways.
I believe so too.
Staff understands. I mean, I think we're
Right.
fine. I think we're
Staff
That's
Chris?
fine, that's a fine way to put it if staff and the
Yeah.
consultants
Chris, you're good?
understand it that way. Great.
PCA is good? Okay. So we have a friendly amended motion on the table. Oh,
I'm sorry.
no problem.
So when we come back with other solution sets,
Right.
and we potentially come back and say, inflation sensitive is, long-term, we've got to roll to the 6 or the 7, that's to get there. You gonna be okay with that?
Yeah, I would. I'll be a little surprised if that's the answer.
I think
I'll
there-
try to find a
We're putting,
different- yeah.
we're saying implementation is a really important consideration too. It's
Yes.
so, I mean,
Yeah, we want something that can be implemented over the 3-year period, so.
Yeah.
Neil, I think
I
you
think
can
you've
feel
heard all of
comfort that this board will express their feelings to you directly. So I think we have proven ourselves to be a very honest and forthcoming board, so we will let you know, but I appreciate the question. So staff and PCA are good with the motion, the friendly amended motion that Tom brought to the table. I think, do we need a second to that friendly amendment, or we have a second to the, okay, so we're good? Okay, so are we ready to, can
Let's
we
do
vote
it.
now? Okay, so all those in favor of this friendly amended motion, say aye.
Aye.
Opposed? There we go. All right, thanks so much.
Thank you.
I think
Thank
it's,
you, thank you, Bob.
Thank you so much, Bob. I really appreciate your analysis. Thank you. Thanks, Neil. I think it's lunchtime. So it's 1:30. I do appreciate everyone's patience. I actually thought at the end that we had some really good momentum. So we're going to take a lunch break and be back at
No, let me.
2, no later.
2 o'clock. So half an hour. Thanks, everyone. We've had lunch now. We have renewed energy for the afternoon. Again, I'm going to go ahead and go to our 11A item, the opportunity for statements from the public, our colleagues at Unite Here. So with the board's permission, we'll move that agenda item up to our first item now. So I believe, do we have Alyssa? So I know that the plan is to make some brief comments to the board. We have a big agenda for the rest of the afternoon, so welcome.
Thank you. Good afternoon, Madam Chair and committee. Thank you for the opportunity to address the committee. My name is Alyssa Giacchino. I follow private equity real estate with Unite Here, the Union of Hotel and Casino Employees, including the employees of Caesars Entertainment. As you know, CalSTRS is a limited partner in both Apollo Investment Fund 6, a buyout fund sponsored by Apollo Global Management, and TPG Partners 5, sponsored by TPG Capital. One of the largest buyouts for these funds was Caesars Entertainment, the largest casino company in the world. Contracts for 44,000 workers in Las Vegas expired June 1st, including 12,000 Caesars workers, some of whom are here to address you today. These contracts are on short-term extensions that can be terminated with a few days' notice. For investors like CalSTRS, Caesars has been deeply disappointing. The market capitalization has lost 2/3 of its value since Apollo and TPG took over in 2008. In May, Apollo CEO Leon Black acknowledged in Oregon that his firm lost its discipline with Caesars by paying too high a price and leveraging too much. TPG's Fund 5 has not performed well either, with a net IRR of negative 2.1 since its 2006 inception as of the end of 2012. Relative to peers, Fund 5's performance earned it a 4th quartile ranking by research firm Preqin. But Apollo and TPG recouped their own GP investments early on. In Apollo's case, it recovered its own commitment on day one through the transaction fees alone, and TPG recovered its GP investment by 2010. Between transaction and monitoring fees, Apollo and TPG have drawn $345 million from Caesars as of the end of 2012. The general partner stands to collect another $150 million in monitoring fees over the next 5 years. The large transaction and monitoring fees clearly create a misalignment of interest between Apollo and TPG as the GP and limited partners, including CalSTRS. While hundreds of millions of dollars have been drained out of Caesars through these fees, the casinos have experienced staffing reductions that negatively impact the guest experience, as workers will describe. Caesars is heavily dependent on succeeding in Las Vegas, where 45% of the company's cash flow, or EBITDA, comes from. For a business built on guests having the time of their lives, cutting staff and sapping out money out of the company through fees hardly seems like a winning formula. We believe Both workers and limited partners like CalSTRS would be best served by cash being reinvested in Caesars rather than pulled out in fees. We urge CalSTRS to ensure the misalignment of interest is reconciled before committing to new funds. We ask that you call upon TPG and Apollo to cease collecting monitoring fees from Caesars. I have shared some materials with the committee. I have folks with me who wish to make very brief comments. They would each like the opportunity to speak, but we will keep it tight in the interest of time. But because we've traveled here, we want to have the chance to address.
Hi, my name is John Vera, and I work at Caesar's Palace. I'm a pot washer. Thank you. I'm a pot washer at Caesar's Palace in Las Vegas, where I've been for the past 7 years. I've been in the hospitality business since 1979. I'm here with other workers from Caesars Entertainment Casinos in Las Vegas. We are here as representatives of the 12,000 Caesars workers in Las Vegas whose contracts expired a few weeks ago. At the same time, we know that Apollo and TPG have drained millions of dollars every year from the company. Now we feel like a cow being milked, but not given enough nutrients to continue, but we push forward with our pride. Our labor force has been cut to the bone, and each person is working as if they were 3. On top of that, our managers are telling us to go faster. Our CEO gets millions in bonuses each year. We don't have the appropriate cleaning supplies to wash our dishes. This causes the plates, the utensils our guests use to go out are not cleaned properly. We feel bad about this because we have pride in what we're doing, but because of lack of cleaning supplies, we don't have that to give to our guests. Thank you for listening.
My name is Oli Stewart. I work as a cook at Harrah's in Las Vegas, where I've been for the past 8 years. As workers, we want Caesars to succeed. Over the past 2 decades, as major casinos in Las Vegas, they grew and raked in profits. Workers have been part of this success. We contribute our energy, our skills as restaurant servers, cooks, and room cleaners to give Las Vegas visitors a great experience and keep them coming back. And though our negotiations for decent contracts were earned fair compensation for our work. I'm a cook at Harrah's Hotel in Las Vegas. I open a restaurant in the morning. I have to go to sometimes a few minutes early because the equipment I need is not available and ready. I have to go to other kitchens to find them. I love cooking and love being able to give good service to our customers. Since TPG and Apollo took over the company, this has been more difficult for me to task. Thank you.
Thank you, Mrs. Sharon. Thank you, everybody. My name is Elmer Portillo. I am a food server at the Planet Hollywood in Las Vegas Hotel. I worked in there for 13 years. So in this past few years, there haven't been so many reductions on supplies, equipment, and the workers. This may hard to me giving to the customer service. With the customer service, what I want to do, but on my coworkers, we want to satisfy customers because we want them to be coming back customers. My job means a lot to me. I try to give it the best service, but with the cutbacks, it is almost impossible. We have a fight really hard in Vegas for have the standard of living what we have. So now I feel like I am fighting just for my job. So thank you for listening.
Hi, my name is Francisco Rufino. I work at a Paris Hotel in Las Vegas, where I've worked for the past 13 years. My coworkers and I also have seen deep cuts in our properties since TPG and Apollo took over. I'm a cook at Village Buffet, and before we used to have cook helpers for every station, but now there's no cooks, there's no cook helpers, less tools, and less equipment. Now I'm running short, and I cannot provide the same service as of work I used to do before. Guests notice this when quality goes down, so they complain to us, and these cuts have made it hard for us to do our type of work and that we can be proud of. Um, I also think about my coworkers who have gotten laid off, and now they cannot no longer provide for their families. Um, we all want to feel good about the work that we do, provide for our families. Ever since the TPG and Apollo took over, we have they have made it more difficult for us. Please urge Caesars to give us a fair contract, and so we could provide for our families and our customers. Thank you.
Good afternoon. My name is Cindy Ferreira. I work as a cook at Caesars Palace Hotel and Casino, where I've worked for over 21 years. I love my job in providing excellent customer service, but TPG and Apollo have made it incredibly difficult. We've seen cutbacks in the number of cooks and kitchen workers. Every day we run out of food and pans. We run to other kitchens to find our supplies. Squeezing more out of workers is not the way to solve Caesars' problems. We can see that things are starting to improve in Las Vegas. We see a fair contract as an investment in the workers that bring Caesars to life. We believe TPG and Apollo should be investing in creating Caesars' success, not sucking out tens of millions in fees. We urge you to demand TPG and Apollo to stop taking out the monitoring fees and instead focus on investing those dollars in building a stronger company to the benefits of the workers and investors like CalSTRS. We are nervous about our negotiations. We have spent decades building a standard for casino workers in Las Vegas that allows us the opportunity to provide for ourselves and our families. We just want to be treated fairly and with respect. We hope these negotiations do not reach a point where we have to take drastic action, but we are getting prepared nonetheless. A couple months ago, we held a membership vote, and nearly 9,000 attended and voted overwhelmingly by 92% to raise our union dues $25 a month in the event of a strike to support our striking workers. We hope to avert a strike, but we are willing to do whatever it takes to continue to provide the future for ourselves, our family, and our community. Thank you.
I want to thank Ms. Giacchino, Mr. Vera, Mr. Stewart, Mr. Portillo, Mr. Rafino, and Ms. Ferreira for your comments. I know it takes a lot of time and effort to make it here and time away from your families and your work, so appreciate your comments. And I would just direct staff to investigate what's going on with TPG and Apollo. And I heard from Ms. Giacchino just the concern around the collection of monitoring fees. And so I just wonder if you could do some research and report back to us at the next board meeting. Thank you. Thanks so much for coming. Appreciate it.